at a minimum, to maintain the current exceptionally accommodative stance of monetary policy until economic slack has been substantially reduced, provided that this does not put at risk either price stability or financial stability.
Mark Carney is here. He has been governor of the Bank of England since July of this year. He was previously governor of the Bank of Canada. He is the first non-Brit to take on the role. He succeeded Sir Mervyn King. The British economy has avoided a triple-dip recession and is now showing some signs of a recovery. Carney gave a speech at the Economic Club of New York in which he said he anticipated the economy to fulfill the hopes and dreams of the holiday season. In the U.S., the latest unemployment numbers have led to some speculation of a tapering by the Federal Reserve's bond-buying program. I am pleased to have Mark Carney at this table for the first time. Welcome.
Thank you very much.
Pleasure to have you here.
Pleasure to be here.
Let me start with Canada and what Canada went through. Tell me what it was about that experience that's instructive for all of us.
I think there are two things. First, on the financial side, we had an advantage in that we saw very early on some of the worst excesses of the shadow banking system.
Right.
So we had deep problems in a little corner of the Canadian market called the non-bank asset-backed commercial paper market. And that little corner, sleepy little corner, 20 billion Canadian dollars of assets that supported ultimately a structure of leverage that exceeded 250 billion US. We saw that early on because it was one of the most egregious examples, and we realized the scale of leverage in the system, and that was the fall of 2007, and that made us move a little quicker than some others who systems were a little more resilient at that point and thought maybe the problems would go away. So we had that advantage. That was instructive in terms of how much leverage you can get through a chain in the system. So it's not just the commercial paper. You got to combine it with certain structured products, and you got to combine those with credit derivatives and other aspects. That's the first thing. The second thing I would say is, and that's a very complex message. It took me about 5 minutes to explain that. Yeah. The other thing I think contribute is that we had some very simple regulations, a leverage ratio, a very simple test. How many assets do you have relative to your capital? And that helped save the core of our system from the worst excesses that were seen in the U.S. and, has to be said, the U.K.
But a significant part of this is recognition that came from the sense that you were able to have a measurement of where you were and you had some understanding of what leverage was doing.
Exactly. A recognition, a good line of sight to how much leverage is in the system, and then once you see that, once you recognize it, you have to move quickly, and that's been the lesson. Whether it was what Tim Geithner and this administration did with the U.S. banks, what Mervyn King and the UK authorities did in advance of my arriving. I'll be clear. I'll give credit where credit's due. In advance of my arriving, to put 140 billion pounds of private money into the banks there to recapitalize the system and move forward.
In a speech on Monday, you said a recovery may be gaining pace, but our economies are a long way from normal. 5 years after the crisis, take a look at where you think we are.
Well, I think it's really just beginning. The true recovery is beginning because the core of the systems are repaired, as I just said. But we have not yet seen businesses really starting to invest, really starting to believe in these recoveries. Businesses recognize they can get, the bigger businesses particularly, lots of access to capital at very competitive rates. I think the concerns of dramatic events, whether from Europe or certainly from the financial system, those concerns have ebbed markedly. So there's not those uncertainties. And the uncertainties really are about the future of demand. Where's it going to come? Is it going to be robust, or can I wait another quarter, another quarter, another quarter? Or do I need to act now? And so this is the start of when we will need to see business investment going forward, and it reflects back on what households are doing, what's happening in the global economy, what the regulatory response, all these other factors are going to influence those day-to-day decisions of businesses. I tried to, in the spirit of the season, as you referenced, to be a little more positive about the near-term outlook, and I feel pretty comfortable about the near-term outlook. But the longer-term outlook is going to turn on these bigger questions of business investment, what happens to productivity, what happens to the so-called supply side of our economies.
Where do you see demand going over the next several years?
Well, it's still going to be. There's still big headwinds.
Right.
Households are still right-sizing their balance sheets. They're still saving a lot more than they were before. If you look at the UK situation, what we don't have, we haven't had that productivity growth that you need to get real wages growing. So we've had a pretty sharp pickup there in the last several months. But it's because households have moved away from having sort of extreme levels of precautionary savings and moved down to more normal levels. And as a consequence, they've been consuming things have been moving. But that only proceeds if incomes start to grow in subsequent years. So you have that aspect in the advanced economies. As you're well aware, I know, in a series of emerging markets, you have some years of adjustment, 1 or 2 more years of adjustment, whether it's India, whether Indonesia, other places like that.
Right.
And so that's continuing to temper export demand for the U.S., for the U.K. And the European situation is vastly improved in terms of the risks, but the dynamism is not yet there. And the dynamism won't be there, it won't even begin to appear until the work that the ECB is doing on fixing the banking system over the course of the next year is completed.
You think they can do that?
Well, I think that without question they need to do that, and they fully recognize it.
Right.
And that certainty, I think, will ensure that they do it. But it is a long process. This is not an approach similar to what the U.S. did, which was effectively rough justice over a 3-month period and then recapitalization, which helped turn things around. This will be a much more methodical process that is already underway.
And on the supply side?
Well, on the supply side, this is the big question. How much permanent damage has been done to productivity, to the potential of our economies? How many workers have been out of work long enough that they've lost the skills, the attachment to labor force, these issues, which are real issues? I'll say one thing, that the two are linked, whether it's the Federal Reserve or the Bank of England. We both see that this adds impetus to giving stimulus now to get people back into work as quickly as possible, to encourage businesses to invest as quickly as possible, or else we will see some detriment on the supply side. That's not normally the way central banks talk about these things, but we think that's the case. To a limited extent right now, we have a catalytic role. But the supply side issues, I think the biggest supply side issue, and I would say this even more strongly sitting in London, given how open the British economy is, given London's role as a global financial center, I think the core supply side issue is maintaining an open global economy, whether it's on the financial side, whether it's on the trade side, and what is needed to build the confidence from Jakarta to Japan to Jacksonville, any of those centers, that this system is going to be there, and it's going to be there for a while.
We've sort of slipped over in terms of talking about UK, and I want to. What's happening to the UK mortgage market?
Well, it's if you look at that mortgage market today versus where it was in 2007 pre-crisis, it's rock solid. Yeah. Back in 2007-8, at that point, 60% of the mortgages you put less than 10% down on a house. Now, 85% of mortgages are the other way. You have to put a lot more down on houses. The underwriting standards have improved dramatically, but this is a housing market that is still relatively firmly valued. Let's put it that way. Yes. Not just in London, more broadly around the country, relative to incomes and relative to historic levels, and where it's starting to pick up again, and within the context of households that have paid down about 30 percentage points of debt relative to their income over the last 5 years, so that's good. But they still have a fair amount of debt relative to income, more debt, in fact, relative to their income than American households. So you look at that situation, you say, okay, there's some welcome recovery in the UK housing market, but let's be prudent, let's act early, let's ensure that it continues to evolve in a constructive way. So we at the Bank of England have taken some steps to try to help.
Well, in fact, you said 5 simple words describe our approach. We're open for business.
Okay, so one of the fundamental lessons we've taken from the financial crisis and where the world needs to get to be have a more resilient financial system is we need more resilient financial markets. Certainly we need to fix the banks and end too big to fail and those things that we can talk about if we want. But we need financial markets that are
be
like
more resilient.
More resilient. So they're more like the equity market. I mean, we didn't like the prices of equities in the fall of 2008,
Right.
but we could always get a price.
Yeah.
You could always transact. Well, you couldn't transact in the global derivatives market. You couldn't transact if you were trying to borrow short term as a bank. I mean, these are tens of trillion dollar markets that shut and brought the system down. So those markets are being fundamentally reformed, and this is where the central bank comes in. Is part of those reforms are the importance of collateral. People aren't taking naked exposure to each other. They need to, I will lend you money if you give me securities or something else as collateral. There are huge markets that are going to develop in collateral and the use of collateral. The central bank is not just a lender of last resort, we think, in the future, to an institution, the traditional role that the Bank of England really founded, but it's also the lender of last resort to those markets, so that those collateral markets keep functioning, so the derivative market keeps functioning, so the bank funding market keeps functioning, so the system keeps functioning when the next shock comes, which it inevitably will. So we're open for business because we understand that we have a continuing role to keep those markets functioning, so the system as a whole is more resilient.
I hear you on resilient financial markets. What are the lessons for monetary policy?
Yeah. Well, I think first, I mean, the very simple one is that monetary policy got itself into a cul-de-sac, where it didn't take seriously financial markets. I mean, the financial systems weren't in the models. There was downplaying of the importance of asset prices or credit dynamics for economic growth, for the risk to the system, and there was a downplaying as well in terms, or really ignoring the interactions between monetary policy and how financial markets behaved. So certain stances of policy encouraged extreme behavior. And I think the lesson we've taken at the Bank of England, UK, British authorities more broadly, what they've taken in reforming the Bank of England has been that you need monetary policy and, in a complementary way, macroprudential policy in order to ensure that in setting, I'll take today's as an example, we need to provide a lot of stimulus to the UK economy. We've got big headwinds from Europe, from the currency, from ongoing deleveraging, from households, so we need to provide a lot of stimulus. But that stimulus can create risks. You mentioned the housing market, that's one example. We need to take other steps in order to reduce those risks, manage those risks, mitigate those risks. And because if we don't, we're going to create bigger problems down the road, or we're going to have to pull back too soon on monetary policy, which is the last thing we want to do.
And what were those steps we ought to take?
Well, the steps we've taken have been to reinforce underwriting standards. And there's a variety of ways where we could adjust the terms under which people can get mortgages if we had to. We could ask banks to put more capital behind every mortgage they give, not necessarily just because of the risk of default, but because of the broader economy-wide effects that, for example, a housing boom and bust could have. So we have measures that we could do, and it's just like monetary policy. If you do smaller things early enough, you don't have to do the really big things later on. So there's an element of anticipation there, and that's what we've tried to do in the UK.
What's your take on what's happening in Japan?
What's happening in Japan is the product of years of the challenge that I was really talking about today. Part of the challenge, effectively a liquidity trap,
right?
And an inability to get real interest rates down quickly enough, and have a well-functioning financial system that transmits that to the broader economy. So they're in a position where you get, with the wisdom of hindsight. It's always easy.
2020.
2020. That by not taking the big steps early enough, they're having to take really big steps now. And I think, as we all recognize, the third arrow is absolutely crucial, because ultimately, when we really talk about creating wealth, for the steps we're taking, this is a common theme, whether it's UK, US, Europe, Japan. We can take steps today, and we have the central banks, to pull forward demand to keep our economies going, right? We lower the cost of interest.
Right.
That's what it does. That works ultimately if incomes grow in the future. And it's the same whether it's a small move here or a big move in Japan. And so the measures that they need to take on the so-called third arrow are absolutely fundamental, or else there won't be the growth of incomes in the future because of productivity and exports and other things. And in their absence, they'll have to pull forward even more demand. In the words of, again, my predecessor, tomorrow becomes yesterday. And you still have to fill in that hole of demand. So it's absolutely instructive. I'll finish with this. It's instructive for all of us in terms of the importance of having coherent policy now and being appropriately aggressive.
When you and other central bankers from China to Europe to Latin America look at the United States, what concerns you?
Well,
about the management of the economy, and is it mostly the political will to do things that many people know is necessary?
I think it's fair to say, and I always hesitate to comment on other people's politics, but it is widely acknowledged, I think here as well as in central banking circles, that a series of decisions on the fiscal side, a series of short-term steps and incentives.
As they say, kicking the can down the road.
Kicking the can, but in the worst of all sense of the words, because we've just gone through 2013, another disappointing year, as I said in my speech today, with huge fiscal drag, almost 2 percentage points of GDP.
Yeah.
That doesn't do anything to fix the longer-term fiscal problems, entitlement, and other problems in the United States. So you got a lot of the pain without any of the long-term gain. Will be less of that next year, but still some big tough decisions. So what concerns us the most is the system can create very difficult short-term situations without the longer-term benefits. So you can, last point, you can look at Europe and extremely difficult situations in Italy and Spain and other places, but in part occasioned by taking big, tough, longer-term structural reforms. And that's a more realistic trade-off.
What gives you pause? I mean, as a central banker who's looked at and know of the relationship between economies, what is it that worries Mark Carney?
Well, I worry about a couple things, and I'm obviously paid to worry. And so I'll step out from the UK issues and look more broadly at your question. I think the first thing I worry about us finishing this global financial reform agenda. And I worry about it for a couple of reasons. One, I worry about it because of the risks that still would exist if we don't finish the job. Right. But secondly, I worry that in its absence, we'll end up with a much more fragmented system on the financial side, and then that will lead to associated fragmentation with respect to global commerce, and we will undo many of the benefits of globalization. So I worry about that. I think that the challenges the Chinese authorities face are considerable. They are the product of tremendous success. They always were going to face these issues in terms of rebalancing the economy. But getting the sequencing right, getting the magnitudes right, will be extremely will be challenging. And it relates back to the first point, which is that we need to take steps that assist in this rebalancing, and we need to also have the patience to recognize that the timetable that's right for China may not perfectly fit for the timetable that's right for some of the advanced economies who are looking to rebalance. So I'll give you one small example, if I may, which is technocratic but important, is we're looking to have an renminbi trading hub in the UK.
Exactly. Right.
And part of the reason we're looking to do that, it's a traditional role for London, but part of the reason is actually internationalization of the renminbi is in China's interest, is in the system's interest. So those are the second two things I worry about. I do share medium to longer term concerns of others about Europe and what ultimately will be needed to build the institutions to ensure that the euro is as viable and resilient as it needs to be. And the timetable, the economic timetable and the political timetable, which rarely coincide, and the difficulty of doing that. So those are the three things.
How do you see where George Osborne and David Cameron what they have been able to do with the economy, and you too? And Mervyn King as well.
Everyone is. Well, I think what's happened in the UK has been that some very tough decisions were taken over the course of the last few years.
And have they been proven right?
Well, I'm going to stay to my patch.
Okay.
Friday, not surprisingly. But, I have to go back there after this.
Yes, that's right.
With respect to the banks particularly. So Mervyn and others went back to the system and said, you just don't have enough capital. We did, you raised a bunch, and your numbers look good, but they're really not good enough. And that we're starting to see the benefit of that. That's the first thing. I think that by retaining their commitment to openness, the authorities there have helped make a difference. And I think what is, because you got to remember, this is an economy that the labor market is very flexible, particularly in a European context, incredibly flexible. And it's, if anything, has become more flexible since the crisis, which is unusual. And part of the consequence of that, in our view, has been that a recession that has been bad enough that the unemployment rate, quote, should be, only economist speaks in these terms, should be 14%, is 7.6% today. Yeah. So by sticking to the first principles around a series of these issues, it has really made a difference.
This debate between growth and austerity, was that just a gross oversimplification of what politics allowed?
Well, I think the rhetoric in that debate was seldom, or quite often didn't match what actually was happening. Mm-hmm. So the scale of austerity in the United States in the last year has dwarfed anything in Europe. And in fact, the scale of austerity in Europe next year will be less than 1% for the Eurozone as a whole in terms of the overall level of fiscal drag if you look at it on a multiplied basis. But you wouldn't know that from the way it's depicted. You wouldn't necessarily have known it by the way the UK was compared to the US as well. Ultimately, macro policy, whether it's monetary or fiscal, can play a role in extreme circumstances. I'll leave to fiscal authorities to decide exactly when they should take bigger steps. I mean, it's really their responsibility. But when you think about longer term, medium to longer term growth, it's not going to come from monetary or fiscal policy. You've got to get those fundamental rights. Right. It's going to come from a host of other supply side policies. And if I may, one of the points I was trying to make in my speech today was, yes, there are some issues in the short term. We got to play these catalytic roles. We got to do the right things, et cetera, et cetera. But if you're really concerned about the supply side, if you're really concerned about productivity growth and potential growth, it's not a game for the central banks. It's not a game in terms of the budget. These are fundamental issues in terms of education infrastructure, in terms of trade, in terms of financial reform. These bigger, tougher issues that you can't distill into a soundbite or a 30-second explanation, and you actually have to execute over year after year after year.
I know you didn't come over here to give Janet Yellen advice. But is it time for tapering?
Charlie, I didn't come here to give Janet Yellen advice. I'm very confident that between Janet and Bill and the other members of the FOMC, they'll take the right decisions. I mean, the U.S. They have flexibility in terms of they have multiple instruments that are moving, both asset purchases and the guidance on the short rates, and we'll leave it to them to. We'll watch. We'll be very interested in the results of their deliberations.
Yeah. And in promoting growth, and we talked about the supply side, what are the tools that are available?
Well, I start from ensuring that we've got a proper open global economy. I think within that absence, we will move into a low growth environment.
So, from your college experience, what was more important? What you learned playing hockey or studying economics?
I sat on the bench a lot playing hockey, so I have to say that, truth be told. So I didn't learn much playing hockey there, so I definitely, I would say studying economics. but I would say, the advantage and the great advantage of that system, the American liberal arts college system, is that mixture of the technical with the liberal arts element of it, because you need in this world both legs.
You really do. I totally agree with you. You really do. And it's almost like we're shifting away from an appreciation of what the liberal arts does for you.
Yeah.
In turn,
I entirely agree. I agree. So the challenge in educational attainment, and I tell my children this, you want to stay with math and statistics and other things, even if you don't really like it, for as long as possible, because the discipline of that thinking will help inform broader decisions. But just as, and I saw you talked about this a few weeks ago, just as, I'm not sure you'd have the Nobel Prize for Fama without Schiller, or you'd be successful in Marcus
without
the two.
Right.
You really, I think you do need both to take full advantage and to have actual human progress.
Yeah. Thank you very much. It's a pleasure to have you on this. I hope we can do this again as we watch what's happening. It is obviously a crucial time, and not because we went through what we went through in 2007 and 8. Because we went through that, people are asking, have we done enough to avoid that?
And have we done enough? No, we've gone a long way on financial reform. We haven't done enough there. And on the bigger questions, we're not talking about them enough because there's a lot of focus. I mean, it's very good of you to have me on your show.
Right.
But I want a world where you don't want me on your show. That should be our objective.
Thank you.
Okay. Thank you very much, Charlie.
Back in a moment. Stay with us.